Greetings, Jonathan Camarda. Hopefully you guys all had a great weekend. A few things to cover here as Fed Chairman Powell made a few comments last week that perhaps the Fed might be looking at more moderate raises in interest rates here, looking at 50 basis points. Market reacted well to that last week. However, Friday came in with a hotter than expected jobs number there and as such, which has put a smaller percentage probability, but nonetheless, another 75 basis point hike on the table, at least if not a sliver of potential there. Now, on a more bullish tone, as we kind of go back historically and look at down years like we've had this year, to say the least, during a midterm election year, very, very attractive returns usually the following year into double digits on average. Now, there has to be an asterisk on that because of the inflationary environment that is not certainly something we see and have seen for a few decades. So you must put a caveat on that. Now, the other thing that is also pretty potentially strong is the last 2 months, October, November, we've had a very strong breadth. So as you've ever heard, market breadth with a DTH on the end of that, bread with a TH on it. And what that means is advancers versus decliners has been pretty robust. 85% both months, advancers versus decliners on the S&P 500, which again portends of pretty strong, resounding resiliency there. Now, the other thing from a technical standpoint that we have not seen for 7 months is the S&P 500 regained its 200-day moving average. That's pretty significant. Last 13 times it's happened since 1950. Only once did it actually revert back below to new lows. Again, worth watching, but then again, we do have that asterisk we mentioned, that caveat of the inflationary environment and the Federal Reserve on the prowl, so to speak. So again, something to look at. Now, that is not to say, as we've been saying, that we are in a bear market. Just kind of giving you both frames. We're not biased either way. And again, that's why we're eternally vigilant here. But we are still within that downward move that you've seen on our past videos. We've had an up move within a downward channel. So until that channel is actually penetrated to the upside, in which we would become with a lot more conviction, we would become long or along the market, buying more risk on assets. Till that happens, we must keep our foot on that proverbial brake pedal. Now, the other thing we've seen, which makes sense with the market rebounding, is obviously interest rates have cooled off with the 10-year down from the low 4s into the mid 3s. And of course, that's helped, as well as a dollar, which has taken some degrees off of the fever that it's had to the upside. And the gains versus global currencies has backed off pretty significantly. So you've seen a little bit more resiliency in the emerging markets and certainly the Japanese yen. Not to go too much on a deep dive on the macro there. But of course, with the dollar going down and rates taking a break, that has been good for bonds and equities as they've basically moved in sync this year. Historic for the bond drop this year. Certainly presenting some opportunities now and into next year, as you've seen in some of your strategies, as well with the fixed income component. Now, with that being said, another beneficiary of the weaker dollar here recently and showing some real resiliency, and you've seen in your strategies, are the gold, silver, and metal minings holdings, which are still showing strength to the upside. So you've seen those really across your strategies and doing quite nicely there. Now, if you're curious of why we don't buy, higher percentages and go hog wild, so to speak, is remember in the metals and commodities department, you should all know, it is a washing machine. Many ups and downs, peaks and troughs, generally a lot more jagged of a trend than even in equities themselves. So therefore, you have to watch the actual dosage of the quote-unquote medication that you take in that area. Nonetheless, has been a good risk diversifier across your strategies there as well. Talk to your personal wealth advisor as far as your percentage of holdings in such asset classes, and of course, the appropriateness within your risk appetite within the models and how they fit into your macro planning, which of course we always say is paramount. So with that being said, again, we look forward to the Fed actual meeting here over the next week to see exactly what rolls off the press. But thus far, we are really approaching the rest of the month, with cautious optimism. It is that seasonally strong time of year, but nonetheless, this is a crazy year. So there are many caveats, as we've already mentioned. Now, many of your large funds you'll see are coming out with more bearish tones. I won't mention names, but across the networks there, looking at stocks have had a nice run. The earnings component of the PE ratio is going to be under stress as we move into next year. And certainly recession, as we talked about, is definitely on the forefront, as we already talked about that inverted yield curve, which we're not going to get into too much crazily here, with lower rates obviously being higher than the longer term rates, with the shorter term rates, excuse me, easy for me to say, shorter term rates being higher than the long term rates. So imagine a seesaw, from short to long, which generally is recessionary. We've already seen job losses starting to begin, although the jobs numbers came in strong. So it's very bifurcated at this point. But nonetheless, again, it's not a black or white issue. It is a shade of gray, and that's basically a good metaphor for how we've been allocated with our head on a swivel. Again, if you have any other questions, certainly address your personal wealth advisor, who stands ready to help you also with year-end planning. Any tax strategies that you need to accomplish. As you know, we proactively look when it's opportunistic to do some tax loss harvesting within some of the taxable strategies like opportunistic growth and income. But however, any individual situations, this is the final month of the year, so certainly talk to your PWA. With that being said, it is a pleasure to serve, as we appreciate your time, your patience, and most importantly, your trust. Until next time, Jonathan Camarda. And don't forget, you have the holiday party coming up this week as well.